These top 5 dividend aristocrats are no less than a dream ticket for shareholders. The more they make money, the greater these companies pay the profits to their investors. These aren't just big companies, they're strategic money-making machines in the S&P 500 index, and you can also invest in these aristocrats for pretty fair deals. First up, let's start with this pharmacy giant, Walgreens Boots Alliance. WBA is currently leading the pack as the top aristocrat, boasting an impressive stock yield of 8.80%. It has been a fast-growing company that has massively improved its dividends for 48 consecutive years and now has become the #1 aristocrat. Walgreens started way back in 1901. Fast forward to 2014, they teamed up with Alliance Boots, becoming the biggest retail pharmacy in both the US and Europe. Today, they're global giants with a footprint in over 25 countries, have more than 21,000 stores, and employ almost 450,000 people. Between 2010 and 2019, WBA boosted its earnings per share by 12% annually. They increased their revenue from $67 billion to a whopping $137 billion, all while enhancing their profit margins and reducing the number of shares available. However, the results fell down in 2020. Thanks to COVID-19, their earnings took a 21% hit, but they bounced back after the pandemic and overcame the progress. From 2007 to 2019, their earnings per share skyrocketed, with an impressive growth rate of over 24% for a decade, and by 2028, it's expected to rise by 4% annually. Currently, Walgreens' share price is around $37, with an expected earnings per share of $455 for 2023. This gives a price-to-earnings ratio of 8.1. Pretty low for such a big player, right? Now, considering some challenges and their growth pace, you can easily aim for a PE target of 10. With the current PE at 8.1, this means potential annual returns could rise by 4.3% over the next 5 years. Doing the math, you can see the possible annual returns of about 13.4% in the next 5 years. It's indeed a good-to-go stock as a buy, but before investing, double-check the stats, as stock yields can fluctuate anytime. Next, let's see 3M Dividends Aristocrats. This company is a real champ when it comes to dividends. They've been paying dividends for over 100 years and raising them for 60 straight years, and that's quite incredible. 3M started in 1902 as a small mining venture called Minnesota Mining and Manufacturing. Fast forward to 2023, they're a global manufacturing giant producing around 60,000 products sold in about 200 countries. In 2022, 3M faced a slight dip in revenue and earnings per share, but in 2023, they're expecting an earnings per share between $8.5 and $9. With a quick estimation, it'll be around $8.75. It's also anticipated that its earnings per share will increase by 5% annually over the next 5 years. And even though they faced some downturns previously in 2008 and 2009, they've always managed to overcome the progress. Also, 3M's dividend game is strong, with a likely payout ratio of around 68% for 2023. However, based on 3M's expected earnings for 2023, their stock has a price-to-earnings ratio of 13.1, which is a bit lower than usual. A fair value would be closer to a ratio of 17. So, the stock seems undervalued right now. But if things align, shareholders could see an annual return boost of 5.3% by 2028. On top of that, 3M has promising earnings growth and a solid 5.3% dividend yield that almost makes up the potential returns of 15.6% through 2028. With all these stats, it's a profitable stock as a buy. Realty Income Corp, symbolized as O, also stands out among dividend aristocrats. They're unique, paying dividends monthly instead of the usual quarterly, and boast a market cap of $36.1 billion. Their recent third-quarter earnings highlighted an impressive 71% revenue increase from the previous year, largely due to new property investments and the acquisition of Realty in 2021. With adjusted funds from operations per share at $0.98, Realty Income continues to be a promising player in the market. But what's behind their success? Smart investments in top-tier portfolios and a rock-solid balance sheet. They've got an A credit rating from Standard & Poor's, which is pretty impressive for a REIT. If you look back, Realty Income has shown resilience even in tough times. During the Great recession, their FFO per share grew by 2.1% annually, and they kept their properties mostly occupied. If you're thinking of investing in O stocks, they're a solid choice. Over the next 5 years, an increasing PFFO ratio could boost annual returns by 0.9%. Add in their estimated 4% FFO growth and a 4.4% dividend yield, and you're looking at potential annual returns of 9.3%. Isn't it a good deal? They've consistently paid monthly dividends with over 625 payments in a row and have increased the dividend more than 116 times. Next, let's talk about Ben, also known as Franklin Resources. With a streak of increasing its dividend for 43 straight years, Ben has seen its ups and downs. The stock's dividend yield is pretty high, though it does vary over time. Despite some challenging years, Ben remains a solid pick for those looking for consistent income. However, some investor says the past few years were tough for Ben, but it still shines through after some downfall. In the asset management industry, ETFs with lower fees have shaken things up. Many had to cut off fees to stay competitive. Despite the difficult operating environment, there are reasons to be optimistic about the company's long-term growth. The U.S. is seeing a surge of baby boomers entering retirement daily. With people living longer, there's a growing demand for investment planning. That would be a game changer for Ben. For the entire 2022 fiscal year, they reported an adjusted net income of $3.63 per share, a small dip from $3.74 in 2021. But they've been smart with their money, ending the year with $6.8 billion in cash and investments. That's the reason Ben is included in the fastest growing aristocrats. Looking ahead, we're estimating about 5% growth in earnings per share over the next 5 years. Their stock's price to earnings ratio is currently at 11.9, which is a bit higher than a fair value estimate of 9.0. This could impact returns in the future. Their 4.0% dividend yield is pretty attractive, and it seems sustainable. Lastly, let's analyze what crazy dividends IBM brought to us. Last year, they upped their dividend for the 27th consecutive year, but the rise was tiny, just 0.6%. Over the past few years, IBM has been trying to reinvent itself. For those who love a good dividend, IBM might catch your eye. They're offering a pretty good yield of around 5%. For the last part of 2022, they made about $16.7 billion, which is pretty much the same as the year before. But if you adjust for currency changes, it's actually a 6% increase. Over the entire year, their hybrid cloud services were a big hit, raking in $22.4 billion, which is an 11% jump. Their earnings per share went up by 15% compared to the previous year, landing at $3.13. Now, for the whole of 2022, IBM's revenue was $60.5 billion, a 6% increase from 2021, but their earnings per share took a 63% dive from the previous year. They had a one-time charge related to some pension changes, which cost them a whopping $5.9 billion. But if we look past that, their adjusted earnings per share actually grew by 15%, reaching $9.13. This balance is what led IBM to be one of the top dividend aristocrats. As for 2023, they're aiming for a cash flow of more than $10.5 billion. If we're talking numbers, that's over $1 billion more than the previous year. However, if you're considering investing in IBM stocks, look at this. Based on the estimates for 2023 and the current stock price, IBM's price to earnings ratio is 14.2. It's a bit higher than what can be considered a fair value. So if you're looking for returns, the stock might give you around 6.1% per year. It's decent but not spectacular. If you're after high yields though, IBM might just be the right stock for you. Simply put, these dividends aristocrats are literally rolling in money. Their high profile doesn't imply these companies don't face losses. Instead, they overcome the loss with great strategies that ultimately result in triple revenues. So let's end this discussion here. Hit that subscribe button and let us know which stock you're considering buying in 2023.